Introduction. In his 1982 letter to Berkshire Hathaway shareholders, Warren Buffett delivers a candid, analytical, and deeply educational account of the company's performance, decisions, and philosophy. He opens by acknowledging a decline in operating earnings relative to equity and unpacks the root causes, primarily poor insurance underwriting results, an expanding capital base, and a shift toward partially owned investments not reflected in reported income. More importantly, Buffett uses the letter to shift the focus away from conventional accounting measures to what he calls economic earnings, urging shareholders to recognize that reported figures often misrepresent true business value. This letter isn't just an annual update. It's an argument for clarity in corporate reporting, discipline in capital deployment, and integrity in management decision-making. Buffett dissects the misleading nature of GAAP earnings in the context of Berkshire's investment strategy, which emphasizes partial ownership in companies like Geico and the Washington Post. He discusses industry conditions, especially in insurance, and highlights why seemingly strong reported earnings may mask deteriorating fundamentals. As always, Buffett communicates with remarkable transparency and wit. This letter, rich with warnings, lessons, and guiding principles, not only explains Berkshire's year, but also educates readers on how to think about business performance in a deeper, more rational way. Section 1. Rethinking performance metrics. Buffett begins by challenging the traditional performance metric of operating earnings as a percentage of equity capital. For most businesses, this ratio remains useful, but for Berkshire, it has become increasingly misleading. Why? First, insurance underwriting results worsen. Second, Berkshire's capital base has grown without corresponding growth in wholly owned operating businesses. Third, and most importantly, the company now holds large stakes in partially owned firms whose retained earnings aren't reflected in its own financial statements under standard accounting rules. Buffett is blunt. Relying solely on reported earnings distorts reality. He criticizes the tendency of managers to discard yardsticks only when results look poor and offers a vivid analogy, shooting an arrow and drawing the bullseye afterward. Instead, he argues for economic earnings, which include both reported income and undistributed earnings from investee companies, regardless of ownership percentage. For example, in 1982, Berkshire's share of Geico's earnings was around $26.5 million, but only $3.5 million in dividends was reflected in accounting income. He emphasizes that long-term value is created when retained earnings are reinvested effectively, not necessarily when they're paid out. Buffett cautions investors to understand that accounting numbers are a starting point, not the final answer, for valuation, especially for Berkshire, where investments in strong, partially owned businesses play a growing role. Understanding economic value over accounting value is crucial. This shift marks a philosophical pivot in how shareholders should evaluate performance going forward. Section 2. Investment strategy and market realities. Buffett expands on Berkshire's approach to investing, distinguishing between full ownership of businesses and fractional ownership through stock purchases. He expresses a clear preference for buying 100% of high-quality companies, but acknowledges how rare and difficult these opportunities are. In their absence, he opts for minority stakes in public companies, so long as each dollar of retained earnings from these businesses is likely to translate into at least $1 of market value over time. However, this strategy relies heavily on disciplined capital allocation and a reasonably priced stock market. If market valuations become inflated, Berkshire's ability to buy attractive businesses at good prices diminishes. Buffett warns that even excellent companies bought at too high a price will yield poor, long-term returns. He illustrates how shareholder value is built not just from earnings growth, but from intelligent purchase decisions and market behavior. Undervalued investments, especially in companies with exceptional management and durable economics, offer leverage to long-term gains, particularly when the market underappreciates intrinsic value. But investors must be cautious. Behavioral swings in the stock market can mislead, and many companies underperform, even as they appear to be earning more. Buffett also reflects on the allure and danger of mergers and acquisitions, admitting that even he was nearly drawn into a bad deal in 1982. Fortunately, circumstances prevented the transaction. This saved the company time, capital, and energy, highlighting again that inaction is sometimes the most value-accretive move an investor can make. Section 3. The insurance business and capital discipline. Buffett turns his attention to the insurance industry, Berkshire's largest and most critical operating segment. The 1982 results were disappointing. Berkshire's underwriting performance deteriorated, moving from above average to below average compared to the industry. Buffett attributes this shift to fierce competition in a saturated, commoditized industry where capital is abundant and prices are often irrationally low. Insurance, he explains, is unlike other industries where new supply takes time and infrastructure. In insurance, capacity is created instantly when an underwriter agrees to take on risk without sufficient pricing discipline. This leads to consistent overcapacity and chronic underwriting losses. Regulatory shifts and changes in distribution have intensified this trend, ending the days when large insurers operated under a semi-administered pricing environment. Buffett doesn't believe the insurance cycle will naturally reverse. Instead, he argues that only a major shock, like a catastrophic event or financial crisis, will lead to reduced capacity and better pricing. Until then, underwriting results will likely remain poor across the industry. Despite this, Buffett remains optimistic about Berkshire's long-term prospects in insurance. With a large capital base, trusted distribution, and disciplined underwriters, the company is well positioned to take advantage of future opportunities when they arise. He praises leaders like Jack Byrne of Geico and Floyd Taylor of Kansas Fire and Casualty for consistently outperforming through lean operations and tight underwriting discipline. Ultimately, Buffett stresses that capital discipline, not blind pursuit of growth, will determine long-term success, especially in industries as unforgiving as insurance. Conclusion: Buffett's 1982 shareholder letter is more than a financial update. It's a masterclass in rational business thinking through detailed commentary on earnings, investment strategy, insurance, and corporate behavior. Buffett reinforces his core message. Shareholder value comes from disciplined capital allocation, clear-eyed evaluation of business realities, and management integrity. He criticizes the common corporate practice of issuing undervalued stock for acquisitions that expand managerial empires but destroy owner wealth. He calls for alignment between management and shareholders, stressing that shares should only be issued if they create at least as much value as they give away. His candor here is rare, offering examples, metaphors, and even humor to dismantle popular justifications for dilution. Buffett also highlights Berkshire's compact and efficient organizational structure. Applauding the small team behind the scenes, he celebrates standout managers like Phil Leashy and Ben Rosner, who treated Berkshire's operations as if they owned them outright. Their dedication, along with Buffett's own cautious approach to investing and expansion, underscores a core Berkshire ethos: quality over quantity and long-term value over short-term optics. For investors and business people alike, this letter offers lasting insights into how to evaluate performance, value companies, and resist the distractions of hype, fads, and corporate vanity. It's Buffett at his sharpest, clearest, and most instructive.